Hello. As someone who invests in their future, you're likely eyeing what drives investment returns. But it's all too easy to be distracted by a number of investment myths. These are nothing but short-term noise that can cause you to miss the big picture of long-term gains. These investment myths are so widespread that even seasoned pros might swear by them. To make smarter moves, you need to separate fact from fiction and focus on what really matters. Let's talk about debunking investment myths and what doesn't drive long-term returns. For the meeting slides and notes, please visit the blog post on my website for a free download. Myth number one is that earnings reports are a primary driver of investment returns. The fact is, investment returns and earnings reports have shown no correlation. If you watch the financial news each quarter, investors wait on pins and needles for their favorite companies to release earnings reports. While these reports offer important updates on how a company is performing and their challenges ahead, they are really poor barometer for long-term investment returns. And there's a tendency to greatly overvalue investment reports when considering a potential investment. So let's take a look at the long-term history chart on this. Looking at the S&P Composite Index, we can see that earnings and returns do not align as expected. In fact, over the past century, there is almost no correlation between earnings growth and investment returns. The key takeaway here is earnings should be taken into light consideration, but don't let these quarterly calls influence long-term investment goals. Myth number two is geopolitical crises are long-term investment negatives. The fact is geopolitical crises can cause minor short-term declines, but usually have no effect on the long-term market outlook. Examples are all over the news headlines today with turmoil in Russia, the Middle East, and China. You might wonder if these fears are reason to be hesitant about your investment, but history shows that while these occurrences may cause temporary volatility, the market is quite resilient to geopolitical headlines. The most recent war between Israel and Hamas caused a 4.5% drawdown in the stock market about a year ago. And over a 14-day period, the market was down, but then the market bounced back over the next 19-day period to a point that investments have gone on to set all-time record highs. Myth number three is that periods of extreme higher or lower valuations are sustainable in the right conditions. The fact is stock valuations almost always gravitate back toward their long-term averages. When examining the price to earnings multiples over time, which is called the PE ratio, it appears that stocks can go through periods of extremely high and low valuations, but these are never sustained. As seen in the chart, the 25-year average PE ratio for the S&P 500 is 16.4, and even though the market has fluctuated above and below this average, valuations usually revert back toward the average. So the key takeaway here is extreme valuations will likely steady over time, so use caution when adjusting your strategy during these drastic periods. Patience is the companion of wisdom. We've always said it's time in the market, not market timing, that counts the most. The financial lesson out of this is to avoid the hype and practice long-term investment fundamentals. If factors like earnings, reports, and geopolitical events don't influence stock returns, then what does? For long-term investors, fundamentals are still the bread and butter of value investing. These include earnings, growth, dividends, and cash flow. The market will always fluctuate based on recent news and events. However, understanding how much weight to give what you hear can help you make decisions with a greater sense of confidence. If you'd like to learn more, please visit our website for a free download of our book, Summit to Retirement: Finding Success on Your Financial Trek. You can visit chapters 3 and 4 of the book to learn more about diversification and investment strategies. Once again, feel free to contact my office with any questions. Thank you for joining us today.